Hey everyone, welcome back to Corporate Decoder, where we help you make sense of the money game and why it matters to you. Today, we're dissecting Algorhythm Holdings, Inc. And boy, do they have some fireworks in this filing. Think stock splits, reincorporation moves, and some interesting voting results. Let's dive in and see what is really going on behind the scenes. If you like getting these kinds of clear, no jargon breakdowns, make sure you are subscribed and join our Discord community, linked in the description below. This is essentially a current report that companies file when something big happens that shareholders need to know about right away. Think of it like a company's bulletin board for really important news. The company we're looking at is Algorhythm Holdings, Incorporated. They are the ones whose stock is traded on the Nasdaq under the ticker symbol RIME. The main event we're talking about here happened on the 20th of November, 2025. This is when the company held its annual meeting and a bunch of key decisions were made. One of the big things approved was an amendment to their 2022 equity incentive plan. Now, what does that mean in simple terms? It is like giving the company more leeway to offer stock options or other forms of stock base pay to its employees and executives. This is often done to attract and keep top talent, or to align employee interests with those of shareholders. The details of exactly how much was approved and in what form are laid out in their proxy statement, which is essentially a detailed explanation of proposals being voted on. The specifics of this plan amendment are filed with this report. This is where we get into the nitty-gritty of what the shareholders actually voted on and the results. It all happened at their 2025 annual meeting. A little over 45% of the company's shares were represented, which is enough to make decisions, so it is a quorum. First off, all 7 of the proposed directors got the green light. This means the current board and leadership structure is staying in place for at least another year. Now, this is a big one. Shareholders approved a reverse stock split. What this means is that the company will consolidate its existing shares into a smaller number of shares. For example, a 1-for-10 split means that for every 10 shares you currently own, you'll end up with 1 share. The company can choose a ratio anywhere from 1-for-2 to 1-for. 10. Why do companies do this? Often it is to boost their stock price. If a stock is trading very low, it might not be seen as a serious investment. A higher stock price can make it more attractive to institutional investors, though it doesn't change the overall value of the company, just the number of shares and the price per share. Another significant move approved was reincorporating the company from Delaware to Nevada. Companies often move their state of incorporation for various reasons, which can include tax benefits, different corporate governance rules, or a more favorable legal environment. Nevada has historically been seen as a business-friendly state for corporations. This is a strategic move that could have long-term implications for how the company operates and pays taxes. This ties back to the earlier point about the equity incentive plan. Shareholders approved increasing the total number of shares that can be issued under this plan to a maximum of 5 million. This gives the company more ammunition to incentivize its employees and executives with stock. This one is definitely worth paying attention to. The company got approval to issue shares to Streeterville Capital, LLC, as part of a prepaid financing arrangement. The key here is that this issuance could equal or exceed 20% of the company's total outstanding shares. This kind of financing can be a way to raise capital quickly, but it can also be dilutive to existing shareholders, meaning your ownership percentage decreases. It is basically selling future stock now for immediate cash. The shareholders also approved keeping Minkei CPAs as their independent accountants for the upcoming fiscal year. This is a standard procedure to ensure the company's financial statements are reviewed by an external auditor. Finally, they approved the possibility of adjourning the meeting if needed to get more votes for some of the key proposals, especially the reverse stock split and the prepaid financing. This suggests there was some uncertainty about getting enough votes initially for those measures. Now let's look at the vote counts for the directors. For Gary Atkinson, there were 629,414 votes for him, 59,085 withheld, and over 505,000 broker non-votes. Broker non-votes happen when the shareholder hasn't instructed their broker how to vote. The other directors listed: Bernardo Mello, Harvey Judkowitz, J.B. Foreman, Ajesh Kapoor, Scott Thorne, and Kapil Gupta all received significantly more votes for them, generally in the 656,000 to 657,000 range for votes in favour, with much lower withheld votes and the same number of broker non-votes. This indicates strong support for all director nominees, with some receiving a slightly larger margin of approval. The reverse stock split proposal got a strong backing, with 1,067,850 votes in favour, and only 125,822 votes against. This shows shareholder confidence in the company's decision to potentially increase its stock price through this maneuver. The move to Nevada also received good support. There were 622,658 votes for it, 35,133 against, and 30,708 abstentions. The broken non-votes are also listed here, representing shares where no instruction was given. This indicates a clear majority favouring the Reincorporation. The amendment to the equity incentive plan received 587,132 votes in favour, 100,999 against, and a small number of abstentions, while approved. The number of votes against is notable and suggests some shareholders may have concerns about increasing the number of shares available for such plans. This prepaid financing proposal, which allows for issuing a significant chunk of shares, had 595,879 shareholder votes in favour. There were 90,038 votes against it and 2,582 abstentions. Again, this proposal passed, but the number of votes against indicates some shareholder apprehension about such a large issuance of stock. The ratification of the independent auditors saw overwhelming support with 1,141,975 votes in favour. This is a routine, but important vote of confidence in the company's financial oversight. Lastly, the adjournment proposal, which allows the company to extend meetings if needed to secure more votes, passed with a very high number of 4 votes, 1112878. This reinforces the idea that the company wanted to ensure it had all the necessary approvals for its key proposals, even if it meant extending discussions. This filing also includes Exhibit 10.1, which is the actual amendment to their 2022 Equity Incentive Plan. This is the document that lays out all the specific details of the plan changes that were approved. The report is signed by Alex Andre, the Chief Financial Officer and General Counsel, indicating he is officially representing Algorhythm Holdings, Incorporated for this filing. Now let's put on our investor hats and decode what this all means for Algorhythm Holdings, Incorporated. The company is clearly making some strategic moves. The reverse stock split is aimed at making the stock price look more attractive, which is often a precursor to trying to attract larger investors or improve market perception. Reincorporating into Nevada is a significant structural change, and usually companies do this to leverage potential tax advantages or a more favorable corporate law environment. The approval of the prepaid financing, which could result in a substantial issuance of new shares, is a bit of a double-edged sword. It provides capital which is essential for growth, but it also dilutes existing shareholders. The fact that they even needed to get approval for an adjournment suggests that getting the votes for these key proposals wasn't a slam dunk. It highlights a potential tension between management's strategic goals and some shareholder concerns, particularly around the dilution from new stock issuance. While the directors were overwhelmingly re-elected, the votes against the equity plan amendment and the prepaid financing proposal show that not all shareholders are entirely on board with every management initiative. In my opinion, Algorhythm Holdings Incorporated is in a phase of looking to reshape its financial and corporate structure. The success of these moves will largely depend on how effectively they use the capital raised and whether the company can deliver on its growth promises to offset the dilution. The biggest risk here is that the increased share count from financing doesn't translate into proportional value creation, leaving existing shareholders with less ownership and potentially no significant gain in stock value. What is your take on Algorhythm Holdings Incorporated's strategic maneuvers? Do you think the reverse stock split and financing will pay off, or are you concerned about the dilution? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give this video a like and subscribe for more in-depth corporate analysis. And don't forget to join our Discord community for more discussions and insights. Thanks for watching, and I'll see you in the next one.